Good morning, this is your DealBook briefing for Thursday, August 6, 2026. I'm Andrew Ross Sorkin, and we have a packed edition today, from a leadership earthquake at Google's AI division, to a controversial new data feed selling millisecond access to the president's social media posts, to a massive unlock of SpaceX shares that could roil private markets. We'll also dig into Malta's rise as a corporate tax haven, the fallout from Michigan's Democratic Senate primary, and a handful of quick hits on SoftBank, FIFA, and the growing influence of special-purpose vehicles in venture capital. Let's dive in. We start with the story that sent shudders through Wall Street yesterday, a major shakeup at the top of Google's artificial intelligence efforts. Investors panicked after Alphabet announced that Demis Hassabis, the Nobel Prize-winning chief executive of Google DeepMind, is stepping out of his operational role to become chair of the unit and chief scientist of Google's parent company. Taking over day-to-day management of DeepMind is Kore Kabachewoglu, a longtime lieutenant to Hassabis. And in a simultaneous blow, Jeff Dean, Google's chief scientist, the company's 30th employee, and one of the most revered figures in its history, announced he is leaving along with 3 other senior researchers to found a new AI startup. Google, notably, plans to invest in that new venture, a sign of apparent comedy. Now, the background here is crucial. According to Semaphore, Hassabis had already been delegating daily management of DeepMind to Kabachewoglu for some time. Dean, despite his legendary status, he built the global computer network that powers Google search and was an early AI leader, had not been at the forefront of the company's recent AI push. Sergey Brin, a Google founder, has been increasingly hands-on. And Hassabis himself has evolved into something of a statesman for the technology. He represented Google at the AI-focused Group of 7 meeting this summer and has been focused on the social impact of AI. He also runs Isomorphic Labs, the AI-driven drug discovery startup spun out of Google, which just raised $600 million led by Thrive Capital, with GV also participating. But the market's reaction wasn't really about the organizational chart. It was about a deeper anxiety. Google is widely seen as an AI also-ran. Yes, Gemini technology has been successfully woven into Google's vast product suite, and the Gemini 3 release in November won plaudits. But the cutting edge has moved to rivals like Anthropic and OpenAI. The high-end Gemini 3.5 Pro model still hasn't shipped. And the talent bleed is real. Noam Shazir went to OpenAI, John Jumper to Anthropic, David Silver founded Ineffable Intelligence. Google has revamped its research division and formed an internal team to improve coding abilities, per the Financial Times. But the question hangs over the company's staggering capital expenditure plan, an estimated $195 to $205 billion this year, mostly AI-focused, more than double last year, and negative free cash flow for the first time since its 2004 IPO. Alphabet did report quadrupled profits to $112 billion on revenue of $119.8 billion, up 24%, with cloud computing a bright spot. But the market is asking, can Google catch up, or is it spending its way into a trap? That tension between massive investment and uncertain returns segues neatly into our next story, which is about a very different kind of market edge. Would you pay as much as $100,000 a month to read President Trump's posts a few milliseconds ahead of everyone else? That's the proposition of Truth API, a new service from Trump Media and Technology Group, the parent of Truth Social. Launched on August 1st, it sells real-time alerts of posts from influential accounts, including the president's, to algorithmic trading firms. 10 customers have signed up so far, according to a person close to the company. The monthly fee runs between $60,000 and $100,000. The economics are stark. Trump Media lost $712 million last year and reported just $871,200 in first quarter sales. This could be a key revenue stream, and as the company's largest shareholder, the president stands to gain directly. The trading logic is simple. In April of last year, a single Trump post declaring a 90-day pause on global tariffs sent the Nasdaq up more than 12% in one session. Hedge funds can, in the words of Jordan Hauer, founder of Amass Insights, make a crazy amount of money with even a tiny head start. But the legal and ethical firestorm is intense. Critics call it insider trading. Senator Mark Warner, Democrat of Virginia, proposed legislation to ban it on Monday. William Birthistle, a University of Chicago law professor and former SEC Division of Investment Management director, told DealBook, "If I were the general counsel of a hedge fund, I'd still be very worried about exposure to legal challenges. A future administration could accuse customers of paying a government official for non-public access to market-moving information, a criminal violation. Users could also face securities law charges for obtaining material non-public information. Trump media pushes back hard. Truth API closes the latency gap for organizations that seek prompt access to publicly available Truth Social posts, and any suggestion that Truth API provides access to non-public information is factually inaccurate. The fight over whether milliseconds of latency constitute a public-private distinction is just beginning. While Truth API sells speed, SpaceX investors are bracing for a deluge of supply. Today marks the expiration of an initial lockup on employee and investor shares. Up to 912 million new shares could hit the market. Shares were rebounding in pre-market trading after a weeks-long slump, but the unlock adds a massive overhang. Some early hires and investors could see a windfall. But it's more complicated for shares held in special purpose vehicles, or SPVs, which have become a primary way high-net-worth investors access private companies. Sri Mupadai reports that SPVs are lightly regulated, and their proliferation has been staggering. Sidecar, a platform that automates SPV creation, has seen $1.79 billion invested across 1,424 SPVs, up from $100 billion across 288 in 2022. Bankers estimate over 1,000 SPVs hold SpaceX stock. The complexity deepens with layered SPVs investing in other SPVs. 2 or 3 layers are common, up to 5 in some cases. Each layer obscures fees, return structures, and whether payouts come in cash or shares. Downstream investors can be at the mercy of those upstream. Some companies, like Anthropic, may not honor stakes held through SPVs at all. Yet fans remain. Kendrick Ko, founder of Fourth Realm, manages more than 10 SpaceX SPVs and expects a roughly tenfold return on a 2021 vehicle. Not everyone is selling. Christine Healy of Healy Pre-IPO says some clients view SpaceX as a generational investment that they want to hold on to for decades. Today's trading will test that conviction. Let's turn to a few quick-moving geopolitical and political items. Oil prices eased yesterday on news that Iran is close to an agreement with Oman to restore safe transit of ships through the Strait of Hormuz. The pact would last up to 4 months, according to Iran's Deputy Foreign Minister Kazem Garibabadi, with no mention of tolls so far. Traders cheered, pushing S&P 500 futures higher. Brent crude traded at $80.40, below recent highs. The agreement would effectively ratify Tehran's control over the crucial waterway, which Iran effectively closed earlier this year in retaliation for US and Israeli attacks. In Zurich, FIFA President Gianni Infantino apologized after an emergency meeting, writing in a letter that mistakes were made in a now-shelved plan to attract private investors. The details remain thin, but the apology signals continued turbulence at soccer's governing body. And in Michigan, the political fallout is just beginning after Tuesday's Democratic Senate primary. Despite being widely outspent and shunned by party leadership, Dr. Abdul El-Sayed, a progressive and relentless critic of Israel, won the nomination. He'll face former Republican Representative Mike Rogers in November in a race critical to Democratic hopes of retaking the Senate. The American Israel Public Affairs Committee poured $32 million into boosting El-Sayed's opponent, Representative Haley Stevens, and failed. Now AIPAC has told allies it's considering a major financial campaign to back Rogers in the general election, a remarkable turn that could see a pro-Israel group funding a Republican in a must-win seat. Our quote of the day comes from billionaire investor Dan Loeb, a vocal critic of New York Mayor Zoran Mamdani, posting on X yesterday, "Many of the loser children of my wealthy friends who see no way to emulate the success of their parents, have gravitated toward Mamdaniism and found community and a sense of purpose by rejecting capitalism as a way to cope with their own failure." The rise of democratic socialist politicians and their appeal to young adults is clearly dismaying many corporate leaders. Now, a deep dive into a story that connects footwear, shell companies, and the shifting geography of global tax avoidance. Crocs sells shoes in 100 countries, but it claims that all of its profits are earned by a 2-person office in Malta. That island nation has become the world's hot new tax haven, and the Big Four accounting firms, KPMG, PwC, Deloitte, and EY, are aggressively marketing the strategies that Crocs and others use. Jesse Drucker and Dylan Friedman report for The Times that Malta refined this appeal over decades. Former Finance Minister John Doley recalled hiring KPMG to draft legislation to compete with Bermuda and Grand Cayman. In Valletta, building after building bears plaques for law and financial firms opening nearly endless shell companies. PwC promoted a double Malta strategy as far back as 2006, promising tax rates in the single digits versus typical corporate rates near 30%. After Ireland cracked down on the double Irish shelters that let companies push profits to zero-tax locales, firms like LinkedIn and Abbott Laboratories replicated the benefits by shifting structures to Malta, a maneuver dubbed the single malt. The number of Maltese subsidiaries established by U.S. companies is booming. Victoria's Secret, Kraft Heinz, and PepsiCo all have offices there. While Malta's statutory corporate tax is 35%, various schemes can reduce the effective rate to nearly zero. Now, with the global minimum tax framework taking hold, Switzerland and Singapore are making moves to shield companies from it. The cat-and-mouse game continues. Finally, the speed read. SoftBank reported impressive quarterly results, helped by a huge gain from its Intel shares. Its Vision Fund's unit value rose $1.7 billion, bolstered by a stake in ByteDance. Days after nearly imploding, Leopold Aschenbrenner's hedge fund reportedly invested $400 million in a private company. The Wall Street Journal reports Trump has called Fed Chair Warsh repeatedly since he took the helm. OpenAI asked a federal judge to throw out Apple's lawsuit accusing it of stealing trade secrets. The rise of the corporate chief of staff, once a note-taker, now a strategic partner as business complexity explodes. And top law firms, including Paul Weiss and Quinn Emanuel, have reportedly held discussions to sell stakes to private equity firms or seek outside funding. That's your DealBook briefing for August 6, 2026. Thanks for listening, we'll see you tomorrow.